Peterhouse Asset Management started its life in 2001, but in its present format took over 6 funds in 2011. Recently, they came into the Peterhouse stable. We have 85 million under management, and our newest fund is the Peterhouse Gold Fund. Gold's money. I'm really hoping by the end of this presentation, no one's going to argue with me about that, but we'll have to see. And if you do have any questions or argumentative parts or not, please feel free to ask us. Throughout history, no paper currency has survived in its original form. Paper currencies are normally inflated away until they're worthless. In fact, the US dollar has declined by 90% since 1950. The situation is the same for most currencies. When governments come under financial pressure, be they war, debts, or just excessive spending, they print money. And gold is the only currency which governments cannot print or attach any liability to. Gold at all times has represented real wealth, as well as being a medium of exchange. And while how much of any given currency you can exchange it for goes up and down, the exchangeability has always been there. And gold has always represented real money for over 7,000, or for several thousand years. All the gold that's ever been mined in the world would fit approximately into the size of an Olympic-sized swimming pool. The highest ever annual gold production was actually reached last year. 3,000 metric tons, or 96 million ounces, was mined. That would fit approximately into a 5-meter cube. Now, over half of that went into jewelry. But before you start thinking that all of the world is adorned in gold, most of that jewelry was 22 to 24 carat jewelry that's bought in Asia as quasi-investments. 18% of it went into official holdings, so central banks, the IMF, etc. 16% went into investments, so ETFs, gold bars, coins. 12% went into industrial use, so cell phones and the like. And that's an interesting aspect of the gold market, because all the gold that's ever been mined, all 166,000 tons of it, is generally still considered to be in existence. But recently, as gold started being used for industrial purposes, it's being consumed for the first time in known history. So the gold that goes into that industrial use generally doesn't stay in the vaults of the people that use it. So we are actually consuming it for the first time. And 2%, we don't really know where it goes, but I'm sure it's in vaults somewhere. Now, 50% of all the gold ever produced has been produced since 1967, and 80% since 1910. So gold, as our population has risen, our consumption of gold has risen as much as it possibly can with that. At present, there's approximately 3/4 of an ounce of gold per person around the world. Unfortunately, with population growth, maintaining that number is going to be quite difficult. I have 10 basic arguments, macroeconomic arguments, for why we as a house think that gold is going to do better going forward. The first one is that gold is actually a currency that is in fact already in a bull run. Gold in Australian dollars, yen, rand, rupees, rubles, euros, it's been up for the last few years. The only currency actually that gold's not performing in is US dollars. Put simply, the reason that gold isn't performing in US dollars is because they don't want it to. The US Treasury realized in 1934 that freely trading gold price could wreak havoc on the dollar. And so they enacted an act of Congress that allows them to privately intervene in the market to control the price for the purposes of stabilizing the dollar. It's not actually a secret. Given that the dollar is the reserve currency of the world, perhaps it isn't even a bad thing. Wild swings would be very dangerous. But in other currencies, gold has been going up. And make no mistake, we are in a currency war. Japan has gone to negative rates, and the rest of us are in negative real rates, if not nominal ones. We're in a currency war, and it's a race to the bottom, and the only real store of value is gold. The best correlation to gold, contrary to what most people think, is actually not the dollar. The best correlation to gold is real rates, real yields, interest rates minus inflation. If you can earn a real return, inflation adjusted in a savings account, you don't need an alternative currency to invest in. Precious metals consistently enter bull markets when real yields decline and then remain in negative territory. The Federal Reserve and the European Central Bank would like inflation to be ideally between 2 and 3%. It's been below 2% for the last couple of years. They want inflation not because it's good for the economy, but because it alleviates the debt burden. We literally inflate away debt. We cannot expect positive real rates or normal monetary policy until the government gets their debt to GDP ratios down to normal levels. In order for debt to GDP ratios to decline, we need the economy to move faster than inflation. And we probably need approximately 6% of nominal growth for the debt burden to come down. When that may or may not happen, I'm not sure. The quantitative theory of money began, ironically, in the 16th century, when Europeans began importing silver and gold from the New World, and they started minting new coins. And suddenly, people started realizing that the value of their coins wasn't buying as much as it used to, and they didn't quite understand why. Quantitative theory of money basically means when you print more money or produce more money, it becomes worth less. Now, money supply has gone up considerably in the last little while, but realistically, it hasn't turned into the serious inflation that we expect it to. And that's because the velocity of money's come down. Not only do you have to print money for inflation to work, but you also have to have the economy moving quickly enough and that money transacting enough in the economy to multiply that money. Unfortunately, since 2008, we simply haven't been growing that quickly. And until we do, that multiplier effect in the economy is unlikely to happen. Over long periods of time, precious metals are actually inversely correlated to the stock market. I've used the UK here because it's what most of us are comparing it to, but a lot of these statistics are in US dollars. The reality is gold's a sector like any other, and it reacts fairly consistently, like other sectors do, to realities in the world, like interest rates, growth, and inflation. In the last 40 years, gold has actually topped the US performance table 6 times, the same number of times as have equities, actually. REITs have actually, or real estate has actually outperformed 11 of those years, better than anything else. In gold's 40 years, it's actually gone up 669%. And it's beaten housing at 500% and cash at 535%. Since 1976, gold rose in all 3 years when US stocks lost 10% or more. The US stock market's recovery since 2008 is now the best 7-year run since 2001, up 169%. But the correction, as we all know, has begun. And if you don't care about gold's fundamental value as a store of wealth, you'd be insane not to realize that gold is also due for a correction based on every statistical norm. I'm not sure if you can see that, but nonetheless, it does show that fairly consistently, gold has always reacted inversely to the UK market. There are leading macro indicators that say that money is flowing back into gold. Carlos Slim, the world's second richest man, started buying gold in 2013 when the price began to fall. Jim Rogers, George Soros, Carl Icahn, Mark Faber, they've all taken very significant positions. But more so than anything else, you need to notice that there's been massive flows back into ETFs, the same kind of flows that precipitated gold's last significant run. The sectors are turning, and it looks like it's gold's turn. Central banks have also gotten in on it. Russia was the largest buyer at 36%. They've also begun selling their commodities for gold rather than dollars. China has stated publicly it wants to achieve 8,000 tons, as much as the US has. Every country that has reserves in dollars and T-bills needs to diversify away from the real negative yields of dollars, and they're doing it in gold. Gold is money today to more of the population participating in economic growth than it ever has been before. The major frontier economies, China, India, the Tigers, Russia, are all buying gold from their central bank down to the individual level. The global population is 7.3 billion, and 60% of them are in Asia. While the West might dither about whether or not gold is really money, I know without a shadow of a doubt that every man, woman, and child in Asia knows that gold is money. And given that their currencies are not as easy to manipulate as the US dollar, they know that owning gold is a hedge against currency volatility, and their governments, unlike ours, are actively encouraging them to invest in it. Money away from bank accounts and manipulated currencies is more important to them than it is to us. And we need to stop thinking in terms of how important gold is to the American and European economies. They're no longer as relevant as they were 20 or even 10 years ago. Gold is money today to more people than it has ever been before, and the amount of gold available to them on a per-person basis is actually going down. Gold is literally getting more rare and more expensive. Present estimates are that there are 52, according to USGS, the US Geological Survey, there are 52,000 tons of gold left. But that gold is lower grade, which means it's moving significantly more rock and increasingly found in remote and difficult locations to access. That means that while cash costs 20 years ago per ounce were around $300, today they are no less than $600. And while finding new gold used to cost $5 an ounce, the average discovery price is higher than $20 an ounce now. And they are finding it in smaller deposits and more remote locations than they ever had before. No really exceptional 10 million ounce plus deposits have been found in over 10 years. We discussed earlier how one of the methods for stabilizing the gold price was derivative trading. On the 27th of January, a whopping 200,000 ounces of gold had been de-warranted at the owner's request from the COMEX. It reduced by 73%, making it 542 to 1 in terms of the number of derivative contracts that were out compared to ounces of registered gold. Now, whether this is just a nomenclature thing is for others to debate, but the reality is that in 2014 and 2015, unprecedented amounts of derivative contracts were being written on an increasingly smaller number of ounces of gold. As we discovered in 2008, the trillions of mortgage-backed securities written on an ever smaller number of actual mortgages, these stories don't tend to end well. For lack of a better way to explain the final argument, I'm going to quote a very good friend of mine, Willem Middelkoop. And his thesis is that the system reset is imminent, probably even before 2020. The world's financial system will need to find a different anchor. The dollar has been the center of the monetary system since the Second World War, but decades of money printing have caused gradual but relentless dollar devaluation. In a desperate attempt to maintain a dollar system, the United States has been waging a war on gold, an increasingly difficult war. China and Russia have pierced through America's silkscreen around gold and the dollar and are no longer willing to continue lending money to the United States. Both countries have been accumulating enormous amounts of gold, positioning themselves for the next phase in what they believe will be the new financial system. There are only two options: a financial reset planned well in advance, or a hastily implemented one on the back of a dollar crisis. It's Willem's very well-researched thesis that the United States, realizing that the dollar will lose its prominent role, is probably planning a monetary reset. But what form that monetary reset will come in, I'm not sure. It will be designed to keep the United States in the driving seat, but it will necessarily include strong roles for the euro and the renminbi, and it's likely gold will be reintroduced to the system as one of the pillars of it. If this is even partially true, gold could easily be revalued up to £7,000, or $7,000 rather, or at least those are the estimates that I've seen. There's an active portion of the world, led by the Chinese, but supported by the Russians and even the Saudis, that want gold to be part of the currency basket. The Shanghai Exchange, the petrodollar basket, people are trying to move away from dependence and control on the US dollar, and having more money denominated in gold supports that aim. Now, our thesis at our fund is that junior equities are actually the best way to play a gold bull market. On a very simple basis, when gold goes up 1%, gold equities tend to go up 2 or 3%, and junior gold equities go up 3 to 10%. In the last 30 years, the average mining junior bear market lasted about 45 months and saw an average decline of 75%. The average bull market lasted for 49 months, and at average it went up 218%. Your best chance of success is in the juniors, if you know how to play them. And there is the rub. And I'm going to quote someone else so that the miners in this room don't kill me later. Maren Somerset Webb, the editor of Money Week and also a columnist at the Financial Times, wrote an article on the 8th of January entitled "Golden Opportunity, the Capital Cycle is Turning." But she caveats that article with the fact that the problem with mining companies historically is that they're run by blithering idiots. The industry's biggest problem, and I'm quoting her here, is management incompetence, lousy acquisitions, endlessly awful misallocation of capital, and the prevalence of a volume mindset over money-making mindset, with most of that down to the fact that CEOs of gold companies are often gold bugs. The reality is you need to know management track records. The only way to play the gold mining equity market is to know all the companies intimately and stock pick the good from the bad. Find companies that are good on their own merits, but that will benefit from a better gold price, but they're not dependent on it. Mark Twain famously defined a mine as a hole in the ground with a liar on top. But forewarned is forearmed, and if you know how to sort the wheat from the chaff, the gold mining equity market is truly a golden opportunity. Thank you. Now, we have with us Peter Hambro, who's the chairman of Petropavlovsk, a significant gold producer in Russia. Tyler Broda, who's the head mining analyst at RBC here in London. Richard Lockwood from Arlington Asset Management. And Dominic Frisby, who's the gold editor at Money Week. I'm going to let each of them have a few minutes to discuss with you their views on how they see the gold market going and what they think the most important things to look at are in the coming, hopefully, gold bull market cycle. And then we're going to open it up to a discussion.